Yesterday, the entire crypto market collapsed. Billions of dollars vanished in just hours. Bitcoin crashed below key support levels, altcoins bled double digits, and panic spread like wildfire. But here's the truth: this wasn't random. There's a real reason behind it, and it's not what the headlines told you. Today, we'll break down the real trigger behind the crash. The three invisible forces moving the market. And exactly what smart investors are doing right now, while everyone else is panicking. What just happened at 3:42 a.m. Coordinated Universal Time? Bitcoin fell 11% within 30 minutes. Ethereum dropped below $2,000, liquidations topped $2 billion, and exchanges struggled to keep up. Social media called it manipulation. Some blamed ETFs. Others said whales dumped their bags. But the data paints a clearer picture. This was a liquidity shock. When traders borrow against their crypto, and prices dip, automated liquidations trigger a chain reaction. One liquidation leads to 10. 10 lead to 1,000. It's a cascade. Markets don't crash when things are bad, they crash when people are over-leveraged. Michael Burry. The invisible forces behind the crash. The hidden leverage bubble. Over 70% of crypto traders use leverage, betting money they don't have. When prices move against them, their positions are liquidated instantly. That's what caused yesterday's collapse. Think of it as a crypto margin call tsunami. 2. The Federal Reserve effect. When the Fed raises rates or hints at staying higher for longer, investors run back to the US dollar. That drains liquidity from risk assets, like crypto. Yesterday's mini collapse coincided with new inflation data showing rates may remain high into 2026. Crypto doesn't move in isolation, it's tethered to global liquidity. Raoul Pal 3. Exchange outflows in whale moved large wallets. Whales moved over $500 million off exchanges hours before the crash. When the biggest players move silently, the market feels it instantly. The aftershock. Retail panic is often the worst part of a crash. Red portfolios trigger fear. Fear drives emotional selling. But here's a truth: seasoned investors understand these moments are when the biggest transfers of wealth happen. Warren Buffett quote cards: calm investors buying on dip. Be fearful when others are greedy, and greedy when others are fearful. Warren Buffett. During the crash, on-chain data showed small investors selling, while long-term holders accumulated. Smart money didn't panic. It positioned. What smart investors are doing now? So, what should you do? Let's break it into 5 clear steps. Step 1. Stop reacting, start observing. Turn off notifications. Don't sell out of emotion. Price crashes are temporary. Bad decisions are permanent. Step 2. Re-evaluate your leverage. If you're using margin or futures, cut exposure immediately. No one ever went broke taking profits, but many did chasing leverage. Step 3. Strengthen your portfolio core. Focus on projects with real adoption: Bitcoin, Ethereum, and top-tier L1s. These survive every cycle. Step 4. Dollar cost average intelligently. Set automated buys over weeks, not days. Volatility becomes your friend when you're consistent. Step 5. Hold dry powder. Cash gives you power when others panic. The biggest opportunities come when nobody else has liquidity. In every market crash, cash is king, and patience is queen. The bigger picture: this isn't just a crypto story. It's a reflection of global fragility, debt, inflation, and over-speculation. Crashes remind us why conviction matters. If you understand why you're investing, temporary noise can't shake you. Every crash writes 2 stories: panic for some, preparation for others. The question is, which one are you writing? So before you sell, step back. Remember, wealth isn't built during the boom, it's built during the storm. Thanks for watching. If this video brought you clarity in chaos, subscribe for more calm, data-driven finance stories.